Most smart people don't stay broke because they're lazy. They stay stuck because they're reasonable. They read the articles. They listen to podcasts. They understand compound interest. They know they should invest. And yet their net worth barely moves. Here's the uncomfortable part. The same intelligence that helps you win in school, land a job, and sound sharp in meetings is often the exact thing quietly sabotaging your financial life. Not because you're dumb, because you're rational. And rational people can justify almost anything. It's not that bad. I'll start next quarter. I need to feel more confident first. I just want to enjoy my 20s. Sounds normal, right? That's the trap. Smart people don't make reckless financial mistakes. They make elegant ones. And elegant mistakes are the hardest to see. By the end of this video, you'll understand why high IQ, high potential, ambitious people, especially in the US, the UK, Canada, Australia, Germany, Switzerland, stay financially stuck for years, while less informed people quietly build wealth. And the twist? It has almost nothing to do with money. Let me ask you something uncomfortable. When was the last time you made a financial decision that felt slightly scary? But correct? Not exciting, not trendy, not socially impressive. Just quietly correct. If you can't remember, that's not random. Most smart people optimize for feeling informed, not being positioned. They track markets but don't allocate capital. They debate macro trends but delay action. They compare brokerages for 6 months but don't invest $1, because thinking feels productive. But thinking is not ownership. And here's the tension. If intelligence was enough, you'd already be financially free. So what's really happening? That's where this gets interesting. 1. The intelligence trap. Picture this. You're 24, maybe 27, maybe 29. You've got a decent job. You read about investing. You understand ETFs. You know about diversification. You've heard of index funds tracking the S&P 500. You're not clueless. So you tell yourself, I'm not behind. I'm just preparing. Preparation feels responsible, almost mature. But here's the subtle behavioral mistake. Smart people confuse information consumption with progress. Reading about the market gives your brain a small dopamine hit. Listening to finance podcasts makes you feel proactive. Watching portfolio breakdowns makes you feel strategic. But none of that compounds. Ownership compounds, and this is where it gets a bit uncomfortable. The less informed person who auto-invests every month into a broad market fund tracking the S&P 500 without obsessing often outpaces the hyper-informed overthinker who waits for clarity. Because clarity is a moving target. There's always another recession forecast, another inflation scare, another headline. At some point, intelligence becomes analysis paralysis. Be honest. How long have you been learning before starting properly? 6 months? 2 years? Since university? That's not a knowledge problem. That's a behavioral one. And here's the kicker. The longer you identify as someone who's researching, the harder it becomes to switch identities to someone who deploys capital. Because now your ego is involved. You don't want to be wrong. But wealth doesn't reward being right. It rewards being invested. And if that stings a bit, good. We're just getting started. 2. Lifestyle inflation disguised as balance. Let's talk about something smart people are exceptionally good at. Justifying upgrades. You got a raise. Of course you move to a nicer apartment. You work hard. Of course you upgrade the car. Safety matters. Of course you travel more. Memories over money, right? None of these are irrational. That's the problem. They're reasonable. And reasonability is the most dangerous mask in personal finance. There's a concept in behavioral finance called hedonic adaptation. You adjust to new comfort levels quickly. What once felt premium becomes baseline. Your $900 flat becomes too small. Your $45K salary becomes tight. Your $70K CHF income in Zurich feels average. So you expand. Then you normalize. Then you defend it. I deserve this. You probably do. But here's the quiet cost. Every lifestyle upgrade increases your financial break-even point. Your freedom threshold moves further away. And this is where smart people miscalculate. They measure success by income growth. But wealth is determined by the gap between earnings and obligations. 2 people make $120,000. One lives on $50K and invests the rest. The other spends $105K because, quality of life. Guess who has optionality at 35? Guess who still needs permission from an employer? This is where it gets personal. Are you building a lifestyle that requires your continued effort, or a system that eventually reduces it? Smart people often optimize for visible status. Wealthy people optimize for invisible leverage. And those are not the same game. Pause for a second. If your income doubled tomorrow, would your investing rate double? Or would your lifestyle quietly expand? Be honest. This might be about you. 3. Risk aversion wearing a suit. Here's another subtle one. Smart people are trained to avoid mistakes. School rewards correctness. Corporate jobs reward risk management. Society rewards stability. So when it comes to investing, you want certainty. You want to understand every angle before moving. But markets don't offer certainty. They offer probability. And probability feels uncomfortable. So what happens? You keep cash just in case. You delay investing because valuations seem high. You wait for the perfect entry point. Meanwhile, time keeps moving. Let me put this plainly. Time in the market beats timing the market, not because it's catchy, but because human psychology is flawed. Look at long-term data from diversified index exposure to the S&P 500. Over decades, it trends upward despite crashes. Yet smart people fixate on downturns. Why? Loss aversion. Behavioral finance shows we feel losses roughly twice as strongly as gains. So your brain says, better to wait. But waiting has an invisible cost. Opportunity cost doesn't show up in your bank app. It doesn't notify you. It just quietly compounds elsewhere. And here's where most people get it wrong. They think risk is volatility. But real risk is not owning productive assets for 10, 20 years. Volatility is temporary discomfort. Underinvestment is permanent delay. Which one are you optimizing against? This is where smart people stay stuck. They avoid visible mistakes, but create invisible ones for identity over income. Now we get to the core. This isn't about spreadsheets. It's about identity. Most ambitious 20-somethings identify as, I'm building my career. I'm increasing my earning power. I'll focus on investing once I make more. Sounds strategic. But here's the hidden assumption. You believe income is the primary lever. It's not. Control is. There are people earning $70K with automated investments, diversified portfolios, and calm discipline, building real net worth. And there are people earning $200K living paycheck to paycheck with better branding. Income impresses others. Control builds freedom. Ask yourself, do you track your spending trends? With the same seriousness. You track your job performance? Do you automate investments like you automate calendar meetings? Or does your financial life run on vibes? This is the mid-video discomfort moment. If your financial system depends on motivation, you don't have a system. You have intention. And intention doesn't compound. Systems do. This is why some average earners quietly pull ahead. They remove emotion from the process. Auto-invest. Broad diversification. Long-term horizon. No drama. No ego. Just boring consistency. It's not flashy. But neither is real wealth. And here's the cause. Effect chain most people miss. High intelligence overthinking. Delayed action. Lower time exposure. Slower compounding. Frustration. More analysis. Loop. Years pass. You're still about to start. So what changes? Not your IQ. Not your salary. Your relationship with control. Financially unstuck people don't feel smarter. They feel calmer. They understand three things. First, you don't need perfect information. You need exposure. Second, lifestyle is a choice, not a reward mechanism. Third, systems beat willpower. This is where long-term thinking comes in. Zoom out 15 years. Not 15 months. 15 years. Imagine two versions of you. Version A keeps optimizing for comfort, status, and intellectual certainty. Version B automates 20-30% of income into diversified assets, keeps fixed costs low relative to earnings, and ignores most noise. Same intelligence. Different identity. One identifies as informed. The other identifies as invested. Which version has options at 40? Which version negotiates from strength? Which version can walk away? That's the real flex. Not income screenshots. Not car upgrades. Optionality. And here's something most people never hear. Financial freedom is not a number. It's a ratio. Assets generating returns relative to your cost of living. Lower the denominator. Grow the numerator. Repeat calmly. No drama. No heroics. Just discipline. If you're 22, 25, 28, this is your edge. You don't need a miracle. You need time in the game. And time only works if you're invested. So here's the quiet shift. Stop asking, how can I make more money? Start asking, how can I increase control over what I already make? Because income without control creates dependency. Control without extreme income can still create freedom. And once you understand that, you stop chasing and start positioning. That's when things accelerate. Not overnight, but predictably. And predictable is powerful. You're not financially stuck because you're incapable. You're stuck because your intelligence has been pointed at the wrong problem. It's been optimizing for certainty instead of exposure, for comfort instead of leverage, for status instead of optionality. Shift that, and everything changes. Calmly. If this hit a little too close to home, good. Awareness is step one. The next step is understanding why control matters more than income in the first place, and how to build it without burning out or obsessing over every dollar. That's exactly what I break down in the next video. You don't need more money, you need control. If you're serious about not being the smart person who stays stuck, that's the logical next step. I'll see you there.